day trading system that works for beginners with options, Forex. This course, a little mini course here, about 6-7 minutes, going to give you the indicators and teach you everything you need to know. Super simple day trading strategy that works. So here is the concept, and it's very simple, as I said. So we're going to look for a market that is consolidating. Now I'm going to give you the parameters to find a consolidating market that I use. So it's going to be very objective and rule-based. So we see that the market is in a very narrow range. And then we're going to look for a big dramatic pop out of this range. But you need this long range before the volatility kicks in. So this is based on a very basic principle that's always worked in the markets, and that is low volatility leads to high volatility. Hey, we love to get into high volatility markets. Why? Because by definition, high volatility markets move in a wide range, and therefore you get big rewards. But you don't want to scan for high volatility markets to trade high volatility markets, because by the time it's already gone through the mathematical movement to show up on a high volatility scan, you're late to the party. So we want to get in actually during the low volatility period. Now, again, we need an objective way to measure that. So here's what I do. Let me pull up my indicators and I'll show you so you can replicate this exactly. So we're just using 4 moving averages, and you can see it right here. You can pause the video if you want to write these down. This is what I use: 15 EMA, the 50 SMA, the 100 SMA, and the 200 SMA. I use these, and there's no magic to these 4 numbers, but there is a principle here, again, that you do want to employ. If you like to use different numbers, that's fine. But you want to use a short term, and then medium term, and a very long term. And the reason that you want to do that, and not just use some short term or medium term ones, is because this is mathematically what tells you that, the market over a long period of time and a short period of time and an intermediate period of time has really not been moving much. So that is how we are going to find an extended period of low volatility. And that's what gives you the odds of the market then going into a high volatility period of time. In other words, the low volatility period of time being over, high volatility period of time about to start. So what we want is we want it to break out of these moving averages. I'm going to go forward a little bit here, and then we're going to come back and I'm going to show you. So boom, there we go. We get a nice big breakout, and that's exactly what we're looking for. Now, there's a nuance here, and there's also an entry. Okay, so let's go back, and again, totally give you the specifics. So the entry signal is 2 things. Number 1, we are going to wait for price to break above the upper moving average of the 4. All right, so we got it there. Now, you might look back here and say, but Barry, wait a minute. We had price above the upper moving average here and here and here, and that is right. And that's where rule number 2 comes in. And rule number 2 is that not only does it have to break above the upper moving average of the 4, but it also must break above the previous highs. So that's rule number 2. So here you'll see that, yes, we broke above the upper moving average, and the previous high now is down here. And it broke above that. Oh, one last little rule 2B, we'll say, is that it must not only break above the high, but it must close above the high of the previous high. So that close is very important. And that's really it. I mean, I told you this was going to be simple. So it works out great. And boom, you could see the big rewards that we had here. And if we change the scaling, it's these big moves. This is what's awesome about these kind of trades, is that, they can really provide big mega profits at very little risk. So, for example, depending on where you wanted to place your risk, if you wanted to place when you get in here, okay, so we're getting in, again, above the high of that bar. So that's our entry. And you can put your protective stop if you wanted to right below the low of that bar. And so let's look at our risk-reward ratio. Our risk is that And then your reward would be, something like, even if you just got out at this first impulse move and you said, okay, I'm just going to get out there. Sure, it went higher. But that's a pretty phenomenal risk-reward ratio right there. And so that's what makes this a fantastic trade setup. Simplicity, high risk-reward, and frankly, high win-loss as well. So we're going to keep it short and sweet here today. If you want to, I've got another gift for you also, and that is if you want to get my market timing indicator, which I use for every single trade I take, and I give it away free to my viewers, meaning you, go to indicatorwebinar.com. And I've now recorded that webinar so you can watch it any time of day or night that you want to, whatever's convenient for you. I give it to you for free. And it's available to everybody who watches my videos, meaning you. So go get it. It's and that indicator I use for every type of trade. So whether it's a consolidation trade like this, a trend trade, trend reversal trade, every type of trade setup, I use this indicator to precisely nail my entries with accuracy and precision. So go get it, indicatorwebinar.com. My gift to you.